Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Welcome to the Going Long podcast with FCLT Global. Today, our guest is C.S. Venkatakrishnan. He is the Group Chief Executive of Barclays. Previously, Venkat served as Head of Global Markets and Group Chief Risk Officer. Prior to joining Barclays in 2016, Venkat worked at J.P. Morgan Chase, where he was Chief Investment Officer in Global Fixed Income, as well as senior roles in investment banking and risk. With decades of experience and expertise in risk management and navigating global markets, having the opportunity to gain his perspective on the heels of the UK's election is a timely privilege. And importantly for us, Venkat has just joined the board of FCLT Global. So thank you for joining us today, Venkat.
Sarah, thank you very much, not just for this opportunity to speak and do this podcast, but for the opportunity to serve on the board. It's a great honor. Thank you.
Thank you. So you've said a few times that the UK should view its financial services sector as a strategic asset. And tell us a little bit more about that. Why do you say that, and what specific policies or actions are you recommending to achieve that? Obviously, London has been a financial center for hundreds of years. Where's it going to go next?
Yeah. Well, Sarah, you started with the right point, which is London has been a financial center for hundreds of years. I'm talking to you today from New York, but when I am in London, if you sit in what is called the city and you look around you and you throw a brick anywhere, you would be where the original insurance industry developed at Lloyd's. You will be where the original exchanges were. You will be where people had contracts, and where lending really became codified and banks became important. I work for Barclays, which is started in 1690, so it's been there for a while. And it began as a collection of Quakers who were lending money against gold. And then, of course, they broadened and, they helped finance the great industrialization of Britain. And even today, it's hard to overstate the contribution that financial services make to the UK. If I may just quote some numbers, financial services count for about 10% of UK GDP. It provides 2.5 million jobs in a country of 60 million adults and a working population of around 25, 30 million. In the UK, and London is the world's leading hub for debt issuance, for currency trading, and about, 38%, 40% of all foreign currency trading happens in the UK. It's also a great export market for financial services. So the UK roughly exports something like $120 billion worth of financial services, whereas the US, that number is probably close to $190 billion. So it's not far behind the US. Of course, the US has a much larger internal market for financial services. And in 2023, the financial services industry contributed to about 12% of the UK's tax receipts. Now, some of my more cynical colleagues will say that's because banks are taxed a little more. But even you take that aside, it's partly because of its size in the economy. And one of the important things, and this has been an issue in the UK, especially after the global financial crisis, when banks had to be rescued there, as they had to be here in New York, has been coming to terms with the fact that not just is this important to the economy, but because of the export market, because of its importance in jobs, that it is a part of the national interest in the UK. And what I feel strongly is that the UK should be harnessing the power of the financial services industry to fuel its growth. You know, and there's a new government in the UK, came in early July. Securing economic growth is one of their most important priorities. They've said it. The UK has been growing at just about flat, so 1%-ish. That's today, it was less than that a year ago, much less than the US, which has been 2 to 3% higher. Better than Europe, but still not good enough, right? Not good enough to meet the growing needs of the population, their demands, and improving quality of life. And at the same time, the sterling was once the world's reserve currency. It no longer is. It's the US dollar. And the UK has a debt to GDP of around 100%, 98%. So what it's got to do to fuel its long-term growth is also to be able to borrow, but it's constrained in borrowing. So the private investment and the markets are really, really important. And three areas where the UK can work to secure the growth in their economy is one, is create conditions for better business investment. The government recognizes this. There's a budget at the end of October. There's a very important global investment summit in early October or mid-October. The second part is that investment can't just be big tickets items and can't just be from abroad. Those are all important, but it's got to be from within. And, one of the things about the UK, which is ironic given the role it's played in investing all over the world for hundreds of years, is that in the last 30, 40 years, it's lost a bit of its equity risk culture. And it needs to revive that equity risk culture. And so that domestic companies will have access to capital from their own citizens. And there are two or three ways to look at it. One is if you look at the London Stock Exchange, where Barclays is listed, it should have more of the growth in tech companies that, in fact, start their lives in the UK, whether it's in life sciences or core technology. We are proud to be listed in the London Stock Exchange, but we're a 330-year-old bank paying dividends, right? Much as I love Barclays, I do think that there should be zippier, snazzier, sexier companies on the London Stock Exchange. For example, one of the promising AI companies, Darktrace, just was taken over by a private equity company, and that's a loss for UK institutional investors. Google bought DeepMind. Similarly, right? These are companies which could have been listed. A part of that came from a very important aspect of risk management in the UK financial services sector, where to reduce the risk in pensions, people used long-term assets like government bonds and inflationary bonds and credit instruments to offset long-term liabilities. But what that meant is that the pension funds, which were providers of capital into the equity markets, weren't investing as much. So I think it's really important, A, to have individuals invest in equities, B, to have better pension reform, C, to update some of the listing requirements, which the government and the FCA is doing, changes to things like stamp duty, which is basically a tax you pay on transactions, and taxes on shareholder and on purchases and dividend income. We just did a piece of research within Barclays, which outlined that we've got about 430 billion pounds, which is about a little over $550 billion of investable cash savings in the UK, held by 13 million consumers. And you need two things here. One is a modified regulatory framework to allow people to advise banks and other providers to allow people to get advice on how to invest. And also, as I said, some of these taxation measures and stamp duty measures. We take it all together, right? And the UK, I think, has to recognize the value that the big banks and the financial system bring to the country, how it's part of the national interest, and domestically raise individual investment to complement the foreign investment which they need.
Well, that is a very clear list. And one of the things that I find fascinating, both from a UK and a global perspective, is obviously the pension plans have shifted dramatically from, in many parts of the world, not all parts of the world, from defined benefit to defined contribution. And to your point, the defined benefit plans have been much more worried about that asset liability matching for good reason. So you don't have many countries, there are a few, Canada and the Netherlands, and a few that have defined benefit plans that really invest in the zippier companies, as you call them. But typically, that's not where that money is coming from now. It's either individuals or other sorts of investments. I know there's Nest and other things in the UK. I was just in Japan. They have something called NISA. So do you think that there are ways to effectively change that equity culture and make it more accessible for either individuals or other sorts of investors who are interested in perhaps the zippier companies, as you put them? What kind of structures do you think could unlock some of that capital?
So I think, yes, there are. I think the first thing to say is that even if we put some of these things in place, it will take a long time. And it always involves a trade-off between a short-term and a long-term, and a trade-off between different kinds of risks, which, previous commentators on our podcast have outlined in different ways, right? So if you, for instance, take what happened with the pension funds, that asset liability management reduced and managed one type of risk, which is that asset liability mismatch. But it created this other risk, which is, what is the risk of not having a proper equity culture within your country, right? And there's a trade-off. And some of the countries which you've spoken about, they are trying to do the same thing, and they do invest in companies, but they invest also globally, right? Now, within the UK, I think there are a couple of ways to do this. First of all, at the individual level, you have to increase education and awareness and advice. And there's a role which all members of the financial community who engage with their customers have to do in a responsible way, and so that people understand the risk returns of investment. The second thing is to make it easier for them, which is not just in terms of financial technology and tools, but in terms of, can we reduce the frictions in the system, right? So such as what they call stamp duty on investment, ways in which people can sort of reduce the transactional costs, right? And, we find it ourselves. There are times when even sophisticated customers would buy the Barclays ADR, the American Depository Receipt, listed in New York, because they don't have to pay that frictional cost rather than buy the shares in London, right? Shouldn't be able to have that kind of arbitrage. Third is on the taxation structure, and this is a short-term cost, on taxation on dividends and capital gains to make it easier. And then fourth, as I said, has been happening, make it easier for companies to list, for some of the zippier companies to list. And so that then they can actually get buy-in from their own investors.
Yeah, that's really interesting. Now, I know one of the things that the new UK government has been talking about is a national wealth fund. And that's been part of this idea to secure growth and investment for the UK. How do you see the private finance side playing a role in that strategy to have a sovereign wealth fund, which hasn't traditionally existed in the UK?
Yeah, that's right. And in fact, I was privileged to serve on a national wealth fund task force to help this government before it came into power, which made recommendations on how to operationalize such a fund. The good thing about the UK is there's already an infrastructure of vehicles through which you can do it. There are areas of very important developmental focus. There's something called GB Energy, which is to look at the transition and sustainability. And, the transition to net zero, as you know, requires vast amounts of capital. Third, the UK actually is blessed with a long coastline, with ample wind resources, and parts of the country, like such as Scotland, are already at 30-40% green power, right? So they've got the resources. And then, of course, fourth, an excellent educational system, lots of fantastic engineers, and the raw technology with which to develop this. So I think focusing on a few areas such as energy, but also life sciences and software, the UK can mobilize private investment and to really push forward and develop companies that do this. And as I said, there's an investment summit that the government has in the works in mid-October, which would help with that.
Right. Well, you mentioned the decarbonization and the sustainable transition. How do you think of financial services' role in financing the sustainable transition? And can you talk a little bit about what Barclays' goals and targets are, and how you're thinking about managing through this somewhat long-term process?
Yeah, I mean, it's this is sort of a topic that's handmade for FCLT, because we're going about something which is a retooling of the way the industrial economy has worked for 200 years, starting in the UK, right? Which coal and other things. In fact, the UK, there was a newspaper article recently that it's shutting down its final coal plant, right? And there are still colleagues of mine who remember coal deliveries in their streets in London in the 1970s. So that's how far we've come. We think global banks have a really, really important role to play in the transformation towards a low carbon economy. There are numbers being thrown around in a wide range. The number we use is about 4 trillion by 2030. Whatever you say, it begins with a T, as in trillion, and it's no number of digits. It's not small. And currently, only about 16% of that, is being met. So less than $1 trillion is being met. Financial services and the way we structure both the way we raise capital, typically banks do it through deposits, but even long-term capital, we have the ability to analyze, value, and fund these long-term infrastructure projects, because many of them are very, very long-term. And there's that on the one hand, and B, finding the investors who've got the risk-return profile to take on startups in climate tech, for instance, some of which will succeed, some of whom will succeed, and some of whom will not. In the end, what does the banking system do or the financial system do? It goes across the world. It finds people with different risk and return objectives, from the VC fund that's willing to risk a lot of money to make high returns, to a pensioner who wants a stable return on their income. And across that entire range, it tries to find ways in which it can allow them to invest, either directly or indirectly, in projects that meet that risk and return. So whether it's a zippy climate tech, which may work out and may not, all the way to a wind farm with a secured power purchase agreement, which will likely succeed and at relatively low risk provide returns. That is the important thing for us to do. What's complicated in this is identifying which projects go where, identifying how that will evolve over time. Because yes, we have wind, yes, we have solar, will we have green hydrogen? How do we go off from coal to oil, from oil to gas? And how do we incentivize that structure? And then, of course, from gas to clean energy. What role does nuclear play in all of this, right? And that is where the financial sector has to be the matchmaker, if you like, right? Government programs are really important here in the US. We've had the IRA, which is a standout example of government incentives. But the thing for all of us to realize is that transition is not a switch, it's a dial. And that dial takes you from more polluting or more carbon emitting sources like coal and oil to less ones or zero, right? But in the process of going to zero, you take on other risks such as rare earth metals, technology, and so on. And we've got to manage that. And I think at the end of the day, there are lots of strong personal opinions which individuals have, which institutions have, on how fast that dial should move and whether it's a switch and not a dial. But if we can agree on the broad principles, then we can be more effective. What are Barclays trying to do? That's the second part of your question. We aim to be a net zero bank by 2050. What that means is, starting with the easy stuff, achieving net zero in our own operations. And that's easier because we can rewire the technology in our buildings. For instance, our campus in Scotland, if it goes off the grid and the grid is 40% green, well, then we are 40% green, right? But more importantly for banks, it is reducing what we call our financed emissions, which is the emissions related to the loans we make to industries of various kinds, which are fossil fuel consumers or emitters, and then financing the transition, helping companies move from more polluting to less polluting. And what we've done is we've created targets in various industries and sectors, by which I mean sectors, energy, aviation, etc. And I won't go through the full list, but broadly, we are committed to about $1 trillion of sustainable finance and transition finance between 2023 and 2030. We're about 12% of the way there. About $120 billion has been done. Some of it is in lending. Some of it is in helping companies change the way they do things. So, for instance, earlier this year, we helped a company called National Grid, which runs the power and transmission lines in the UK, raise £7 billion for long-term infrastructure improvements in their networks. Because what they have to do is upgrade their networks to A, lose less energy in network transmission, have better tech around it, but B, support solar and wind and, individuals who generate power in their houses and then pump it back to the grid. Our second mandate, so the first mandate is $1 trillion of sustainable and transition finance. The second is to invest about $500 million of our own capital in projects linked to this. And we've done about 160 as of the first half of this year, so about a third of the way there. And we've made investments into some very innovative companies. I hope they succeed. There is a company that's called Geopura, which creates a technology to replace diesel generators with hydrogen-powered alternatives. This is ambitious. So it's a combination of changing the way we do it, changing who we finance, and investing in this transition.
Yeah, that's it. It is. Yeah, I like your analogy of a dial versus a switch, and how we sort of move. What are the implications when we move from sort of one part of the dial to the next, and how do we keep that dial moving? It's so important, and it's hard to you can't skip parts of a dial, and so that's I think that's a really interesting way of looking at it. We've been thinking a lot about what are the forces of disruption. Of course, long-term forces of disruption. Decarbonization is one of them. We think of demographics, which are changing around the world. We think of deglobalization oftentimes, at deleveraging as rates have come up. And so these are kind of our 5Ds, and then we'll come back to digitization or AI. But as you think about disruption and some of the disruptions that are going on around the world, what do you think are the sort of the geopolitical risks and disruptions that to global capital flows? And particularly, we're in the year of elections. You've had an election in the UK. We're about to have one in the US. The French have had one. Other people have had them. How do we think about this? The Indians had one earlier in the year. So there are a lot of political and geopolitical disruptions going on around the world. How do you factor that into how you think about some of the risks that you've got to manage at Barclays?
Yeah. It is a period of change. I started my career in the financial services industry 30 years ago this week, on September 19th, last week. And what I the world has changed in some ways and not in some other ways. But obviously, the early 90s, post the fall of the Berlin Wall and the peace dividend, as we used to call it then, and the integration of what was then the Eastern Bloc into the economic system, the free trade agreement with China and China's further integration into the global economic system, was a period of great outward investment from the United States and developed economies, and a period of real growth across the world in Asia. India started liberalizing in 1991. Some of those things have continued, and some of those things, as we know, have been disrupted. So China has probably had the most dramatic increase in that any country has shown over this period in its share of global GDP. Off the top of my head, it's a couple of percent in 1980 or 1990 to probably 20+% today. The US has remarkably remained stable. In the meantime, you've also had a European Union. And if they were to borrow a line from the US, they would say they're striving towards a more perfect union. And that European Union project has been disrupted by the British Brexit. And then, of course, we have the situation with Russia and Ukraine and the detachment of Russia from that system. All of this leads to sort of two or three aspects of how a bank and the financial system work. One is, what is the plumbing? Right? How do we send money to each other? What is that basic system? And what's the role of the US dollar in it? The second is, how does regulation work? Right? Can you strive towards a global regulation, or is it still very domestic? And third is, what is it that you're financing? Are you financing companies going abroad, or are you financing companies at home? If you take the first one, which is the role of the dollar still is the world's preeminent currency. And a lot of the world's financial systems are wired around the dollar, right? And so you have to send money, you send it in dollars. People trade with each other in US dollars. Oil is denominated in US dollars. What you're seeing is a beginning of a desire, in some cases people going further than that, to try to break what they would call dollar hegemony, right? Which is Russia trying to get its oil trade denominated not in dollars, China similarly trying to have the renminbi used as a currency in certain parts of Southeast Asia. I think it's at a very early stage, but we've got to watch that disruption. It's a part of deglobalization. I would say it's a subset of it. The second thing was what I called, are you serving a global financial system, and what is regulation like? On the one hand, after the financial crisis, you've had what we call Basel, and you would have, very recently we've had news about the US Basel proposals, the UK Basel proposals. I would say they're not identical. They may rhyme, but they're not identical. And banks, large global banks like us, have to sort of navigate between the two. But it is fair to say that the financial systems of the world are not converging in the way we would have thought, right? And so if you're a global bank, you deal as much with local regimes as you do with global regimes, right? And you've got to ask yourself, which local regimes do you want to be in? How much do you trust it? And how enduring do you think it is? And some countries have a better track record of it than others, right? And then the last thing is, who are you financing? And I think, again, we've seen after the Russian-Ukraine invasion, many foreign companies had to pull out of Russia. So the banks who follow the trade have also had to reduce their operations. We see the use of sanctions, which comes back to the first one, which is the control of payment systems. All of which means that the large banks have to think as much of their home country as they do of international banking. International banking is still very, very important, don't get me wrong, right? But that emphasis of going abroad, that was there when I joined this industry, has probably reduced. It's not a great thing, but it has probably reduced. So I think we have to have a view then over the next 30 years as to how these trends will shape. And I think it's important to be flexible. And as this change happens, we will see things that we had not anticipated, and we have to be able to respond to them.
Yeah, I think that's probably a good watchword, is sort of have that long-term, 1620 mindset. Imagine what the person sitting in your chair in 1620 saw versus how are we flexible when markets and economies inevitably give us things, and politics inevitably give us things that we didn't foresee. Let's come back to AI, which of course is such an important issue right now, both in terms of its impact on financial services, its impact on global markets. Can you talk a little bit? And I know you went to MIT. I'm not sure if you studied AI at MIT, but as a Boston person, I'm throwing that in. And so, how do you think about AI, and how quickly do you think these things are going to happen? And maybe if we take that long-term view, do you think this is going to create value, destroy value, upend parts of the financial services industry? What's your crystal ball a little bit for AI?
Yeah, there actually was a course in AI when I was at MIT. The MIT had course numbers, and I think it was called 6034. It was taught by a guy called Patrick Winston. But of course, it was a very different AI than the one we're talking about now. So banks have always been users of technology and early adopters of technology, whether it was carrier pigeons carrying news of wars, or steamships, or trains, or the telegraph, or the telephone. You can read about the great financiers at the start of the last century installing telephone lines and central exchanges on Wall Street, right? Because that was really, really important. And AI is no different. The important thing for us is the traditional forms of AI have been fairly well adopted in financial services, in fraud detection, trying to find patterns and rules, in trade management, in trading and risk management. Risk management, we always, when we make loans, we have to figure out what is the chance that somebody defaults on the loan. And as you can imagine, that is a larger and larger and larger statistical exercise, right? And you try to get all the data you can about where they spend, how they spend, how much money do they make, where do they make the money. Generative AI creates a next level of opportunities, both through the use of natural language and reasoning capabilities. Now, we are a consumer-facing business, so what we've got to do is to find the ways in which it can be potent in making us better at delivering the services, but in a way that does not diminish the trust that people face in financial institutions. So you've probably done your little experiments with ChatGPT, where you ask it to read something and give you an answer. And, it works pretty well, but it doesn't work perfectly well, right? And I'm sure there's a point at which, and the evolution is quite rapid, there is a point at which it will work well. But in the meantime, what you've got to do is be understanding of where it can give you improvement. And there are very important areas in document production, in customer service, even in helping you with doing analysis. But the most important thing for a financial service company is to make sure that if that answer is used in something dealing with a customer, that it does so in a way that cannot in any way affect or diminish the trust that the customer has in either that their statement is correct, that a transaction will happen, that if we say we will do X, we will do X. Right? That's the critical line that we've got to be well within.
And trust is such an important part of banking. I mean, as you said, from the beginning, whatever the methodology was back all of those years ago, do you think that do you think people trust machines more than people? I mean, as I'm sure you know, Gen AI gets to know you a little bit, and if you use a particular model, it gets to know what you like and don't like. And and people are using it in trust-based environments like healthcare and other things where trust is important. But do we trust it, or is trust a matter of how do we define that? Is it just a matter of making mistakes, or is it deeper than that?
Yeah. So we've got to trust as an institution that when we provide information, it's correct. And the receiver of the information has got to trust that what they're receiving is actually correct and reflects what they believe and is the truth of financials or statement or whatever. You can see behind me a series of Barclays eagles. On the top left is the eagle that we had outside our branch in 1690. And on the bottom right, in a sort of more fancy modern design, is a more recent one. Throughout that period, somebody who deposited money with us and the person who was in my shoes or working at a bank teller had to know that if a customer had X in their account, it really was X. And the customer had to believe that if they came tomorrow morning and asked for X, they would get X, right? Because A, that is what they had, and B, we as a bank could deliver it to them, right? So I think it will develop. I think as we, my mother would never believe a bank balance that she saw on her iPhone or on a phone. I had to get a paper copy of it and show it to her, and then she'd believe it was her real money, as recently as a few years ago. So that's one generation, and we still have customers like that, right, who want the paper statements. And then we will have some of our younger customers who will be early adopters of some of our newer technologies and willing to understand that, if we make forecasts of income, forecasts of net wealth, and so on, there's a margin of error around it because they understand the technology that goes into it. And then there'll be a range in between. I think the most important thing for us as a provider of financial services is through all this technology, we have to test it to make sure that the numbers are correct and we trust the numbers and that we can therefore represent them. And the consumers have to believe that also. And you see it from time to time, when the Russia-Ukraine invasion happened, we didn't have a physical presence, but we were doing trade and sending money through the Russian banking system. And it would have been naive to expect that if you put return on a transfer, you hit return on your computer, the money went. Right? You actually had to read the rules about settlement times and exchanges and when it worked, et cetera, et cetera. And so that's when trust is questioned. Right. So that fundamental knowledge of the plumbing is important. We can abstract away from it, but in times of stress, we need to know what it is.
In times of stress, you always need to know where the money is, right? That's
exactly right.
So there are all these changes going on, disruptions around the world, technology, et cetera. How do you take a long-term view to strategy and, as you said before, be flexible, adapt to these things? Is there a way to outline your strategy in a nutshell that both takes advantage of your long history and also looks forward for a long period of time, benefits from that long-term mindset that you've got, but also hits short-term milestones that you need to hit and responds well to near-term changes in the market? How do you think about your business and your strategy in this very complex world we're in?
Look, we want to be a partner for financial services and growth for all our clients. And we also want to be a trusted leader in banking centered in the UK. And what that does ultimately come down to is, what services are you providing? Are you good at them? And can you do so efficiently because we're a profit-making concern? Do they fit well together so that they can weather the ups and downs of economic cycles, because each sub-business has its own cycle? And where in the world are you offering them? Coming back to our first question. So what we are in the UK is a full-service bank. We do everything from retail banking, to the one-year-old kid who's just received her first birthday gift present, and we have a bank account in her name, all the way to, through the careers of lives, through people's lives, their first credit card, their first mortgage on their house, helping them save money, accumulate wealth, and ultimately, some very wealthy people. So that full thing. Similarly, the life cycle of companies, small businesses, which can then become medium-sized businesses and corporates, and then hopefully one day list on the London Stock Exchange. Coming back to what we said earlier. We're also a global investment bank that helps UK companies invest abroad and foreign companies invest in the UK. This is part of our DNA. This is what this bank has done for 300 odd years. We also have a very large global investment bank centered here in New York, built through the acquisition of Lehman Brothers after the financial crisis, and a retail presence in the US, which is a very similar market to the UK. And our global presence in investment banking cuts across Europe and the Far East and India, and it looks to take advantage of the connections to London, which, as I said at the beginning, is an important global financial center. We think that kind of footprint, connectedness to London, helping people grow their financial futures and develop their financial futures, being a UK-based leading bank, all work together. Anything that deviates much from it should not be part of it. And I think the most important thing here is to be disciplined, not just in what you do, but what you don't do. You can get carried away very, very easily. And, a question to ask is, in banking, the fundamental thing is trust in your financial as you store people's wealth and you help them accumulate wealth, to provide them financial wherewithal when they need it. So loans, credit cards, mortgages, loans to companies, allow them to access the financial markets either through equity investments or to help them do mergers and ultimately to list and to bring investment into them. That's what we do. How we do it, the technology, the intelligence, the different sectors of the economy, that changes over time, right? But whoever was sitting in Barclays 300 years ago would understand the fundamental relationship which we have with our customer today. They'd recognize it completely, right? It doesn't matter if we're doing sophisticated derivatives or prime brokerage for a hedge fund and so on. They'd recognize that we're helping companies operate. We're lending them money. We're providing financial services. They may not recognize the way in which we do it. And I think if you stick to that core and keep your values of being a good partner, fiduciary responsibility, and trustworthiness, then those are the recipes, the enduring recipes for success.
Well, that is a great place to end, which is really those long-term mindsets of serving the customer, helping them compete, helping them access capital markets. I think I can almost imagine the Quakers understanding, sitting there understanding that in 1620. But even if they might not recognize the devices we have today, and I can only imagine the way that Barclays would be doing that, 100 years from now. So thank you so much for your time today. We really appreciate your wisdom and insight on this podcast, and we're really grateful for your support and time working with FCLT Global. So thank you.
Thank you, Sarah. It's been a privilege.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.